Hello everyone, welcome to Just Invest Today, guys. And today we're going to be talking about this one book called 100 to 1 in the Stock Market. Yes, I want to do a book review on this book, and I just want to go over some, like at least like 5, 6 passages on what has really influenced me and how this book has did tremendous work on me, meaning that it changes your mindset, it changes your focus. And guys, and when you read books, and that's what you want. So I want to see if I can just provide you guys with a huge amount of value going forward in your stock market practice. And if you just read this book right here, Hundreds to One in the Stock Market by Thomas W. Phelps, and 100 Baggers by Chris Mayer. These two books, guys, that's almost all you need right now if you already know all the basics, because this is going to change your whole framework. So let's get into it right now. So starting out in this book, Thomas W. Phelps wants you to know that there's always huge opportunities in the stock market to make 100 to 1. Is that you guys always feel like you guys are late to the party, you're guys FOMOing, oh, the market is too high right now, there's no more opportunities. And guys, that's more than wrong. That's wrong because guess there's so many stocks in the market, guys. You can invest in China, India, the US, Argentina, guys. There's probably 50,000 plus stocks in the market. Are you saying that every stock is fairly valued or overvalued right now? No. There's always going to be a stock that's going to return 100 to 1 in 2021. So guys, he's just trying to show you that, guys. People always think that like there's always going to be 100 to 1 stock, even in 1936 and 37 and 38 and 39, 40, whatever year there is, there's going to be a stock right now in 2021. If we look 20 years down the line, that's going to return 100 to 1, even in this overvalued market. So guys, finding the stocks is more important than thinking about what's going to happen in the market right now. Think about that stock that you want to get right now. Guys, if you buy a high quality business, high quality stock, even if you buy it at maybe at a price that's a little bit overvalued, think about that company if it's a high quality company in 20 years. What? Are you going to be complaining that you made 60x instead of 100x? No, you're not going to complain. The most important thing is finding these companies and actually getting into these companies, right? And that's what he wants you to grasp, that concept of actually buying into quality companies. And there's always going to be times in the market, no matter if it's up, no matter if it's down or sideways, that there's going to be finding stocks is the most important thing. And finding those stocks that are going to return 100 to 1. So guys, make sure you're always keeping your mind open, even if the market is overvalued. Always stay looking, always keep your mind looking and trying to analyze different companies, because guys, you never know if that stock is going to be the next 100 to 1 when you're looking back the next 20 years. We are too soon old and too late smart. Good judgment comes from experience, and experience comes from bad judgment. I've had a great deal of experience. Man, this quote hits home for Thomas W. Phelps. He's just basically giving you out there, guys, that he had so much bad experience of selling stocks too early. He became too smart too late in his investment journey. And that's how we are going to take that and we're going to apply it to our next investments. So in that quote, he's basically saying that he learned that actually holding stocks is the best way to make money in the market. When you hold good quality stocks, no matter ups and downs or whatever the market's doing, you don't hold it willy-nilly. You make sure the company is still generating high earnings. And if it's still generating high earnings, you don't care what the market's doing. The purpose of the investors' Wall Street news articles is to get you to sell your stocks, get activity. You got to pay fees, brokerage fees, you got to pay capital gains tax, you got to pay all that type of stuff. And that's what the government, that's what Wall Street, that's what they want you to do. They want you to sell your stocks. They want to help you out and keep your that high turnover portfolio. That's what Wall Street wants. And Phelps learned that way too late in his journey. He was too old. Because remember, investing is all about time. To get that 100 to 1, you need at least 20 years. Like, that was the minimum, that was usually the minimum amount of time is 20 years. You can get shorter to like 10 years, but that company has to be a high flyer, earning like 36, 40% a year, which is very hard to do. But if your company earns like 20% a year, around 20, 25% a year, you can get that 100 bagger in like 20 years. So he learned way too late that holding high quality investments is your best bet to make 101 in the stock market. When we're looking for 100 to 1 stocks that are going to return 100 to 1, here's what Thomas W. Phelps looks for. So, number one, it must be small, a sheer size against great growth. So, guys, huge companies or really big companies are going to be hard to keep continuing to grow because how fast is that a company can grow? If it's already at like 100 billion market cap, what is it gonna grow to? It has to go to like $100 trillion market cap, like, and that's gonna be bigger than all the economy. So it's very unlikely that these companies are gonna grow to like 20 trillion or whatever amount, right? So the small size is gonna actually help your investment games, finding these companies that are actually smaller. Number two, it must be relatively unknown. Popular growth stocks may keep on growing, but too often one has to pay for expected growth too many years in advance. When it comes to that, these popular growth stocks have already everything already priced into it. And when you already price into everything of that growth, it's going to be hard to get that 100 to 1 stock growth, right? Because we got to think of it. The two growth factors, right, is the earnings and then the growth in PE, right? So if there's already a huge growth on that PE of that company, it's going to be hard for that huge multiple expansion of the PE to keep going higher and keep going higher. So it's going to just be harder. You can still do it. You can still find companies with a high PE, but it might be just harder for that growth to happen. So number three, it must have a unique product that would do an essential job better, cheaper, and faster than before, and provide a new service with prospects of great long continued sales increases. So this is key because we want to find stuff in the market that's going to provide value to customers. And when you provide good, solid value to customers, that's just going to continue that product line and continue that growth into the future. And customers are going to be more attracted to that company. So that's a key thing. And then the last thing, number four, it must have a strong, progressive, research-minded management. And management is key. What are they doing with the company? Are they reinvesting that money in that company to keep it growing? Has a strong mind, progressive, thinking about the future? Companies that are not thinking about the future are just going to be left behind because capitalism is brutal and people are going to find ways to take down your company, actually get into those huge profit margins. So that's what you're going to be open to. You're going to keep your mind open to. You got to research management and know what they're doing. One of the hardest things to do, and what Thomas W. Phelps keeps going back to, is holding your stocks. It's so hard to hold your stocks for 20 years, 10 plus years, because there's going to be so many times in the market, maybe your stock doesn't go anywhere for 2-3 years, right? Or maybe it goes somewhere for 2 years and then it goes back down for another 2 years. And then you just get out, right? But he's trying to make it seem, he's trying to drill it into your heads that sometimes you can't look at the price movements of those stocks. You actually have to look at the value. What kind of value is the company bringing, right? And that's very key because, guys, if you just look at the earnings of the company, the earnings power, how it's continuously generating money for the company, then you don't have to look at what the stock is doing on the price of the market. Warren Buffett always says that if you buy a farm, you don't look for it to make money the next quarter, the next year, the next 2 years. We're looking out 10 years into the future. So if that company is still generating high earnings, revenue growth, all that good all those good, strong metrics, leave that company alone, right? So let's get into it. So never, if you can help it, take an investment action for a non-investment reason. What are some of the non-investment reasons for which tens of thousands of investors go wrong? Let me cite just a few. My stock is too high. You hear that all the time. My stock is too high, so I'm going to sell. I need to realize capital gain to offset, realize capital losses for tax purposes. My stock is not moving. Others are. I cannot or will not put more money to meet my margin call. Taxes will be higher next year. New management, new competition. The possibility that one or all of these reasons may warrant a sale switch should be weighed carefully, of course, but the difference between possibility and reality is roughly the difference between track soup and moose steak. The track soup is what hunters have supper when they come home empty-handed. So all these stupid things and stuff you're looking at to make a sale of your stocks is not worthy, guys. We only make these sales if there's an investment reason saying that something in their company is going wrong. It's not short term, it's long term. There's problems with there's problems with like management doing something crazy with the company, like stuff like that, like real business reasons why you sell your stock, not because it's too high right now. That's not a good solid reason, right? Because we want to hold these stocks that are high quality businesses forever if we can. And a reason why, guys, that a lot of us never get 100 to 1 in the stock market is because we never have that framework. And what this book does, it gives us that amazing framework. So it's really crucial that we implement what this book, Thomas W. Phelps, is giving us in this book. So let's go over some quotes. The basic reason so few of us have ever made 100 on a 1 investment is that we have never tried to do so. In a sense, we have been brainwashed into looking for acting on types of information and have little or nothing to do with multiplying one's investment 100-fold. And this goes back to the main reason Wall Street is based on activity. Wall Street wants you to go in and out of stocks like crazy. That's how they make their money, on wily activity, guys. So keep that in mind. A great many people, I am sure, have never set out to increase their capital 100-fold because they have no idea that it could be done. Much investment research is misdirected from the point of view of one wanting to increase his capital rather than play the market. When I said news media share the responsibility for some of the unprofitable overtrading that goes on, I have in mind the way some preen themselves on stories and move the market. Much of the news is immaterial to the truly long-term investors. Some news has the opposite of its seemingly obvious significance. Shrewd investors recognize bad news as a chance to acquire good stocks at bargain prices. That is why so often, after a savage general market decline, we see stocks moving up first. So this just goes back to show you that Wall Street wants to generate a lot of news, a lot of media on the stock markets, on the stock, just to get you to have a lot of activity, get you in and out of stocks, more brokerage fees, more Wall Street mania, more you're going to go to these hedge funds and put your money in because you're worried about what the government's going to do in their bond market and all that stuff. So it's just getting you scared, getting you providing hyperactivity. So guys, be wary of what Wall Street does. So the last things I want to say about this book is that, guys, and what I've learned is that remember that Wall Street has a huge disadvantage compared to us as an individual investors. Remember, they have to report to their bosses, so they're not allowed to hold stocks through the ups and downs, the down years, even if the company is generating high returns. They have to, remember, kind of require money. They need money from outside investors, so they gotta prove it. They gotta show their returns like quarter after quarter, year after year. And guys, when you gotta do that, you gotta actually move in and out of stocks because you can't have these huge quarter to quarter declines because that's gonna hurt your investment returns quarter over quarter. So that's how these big investments, big hedge funds, they go in and out of all of these companies, right? But as small investors like us, we're able to buy these companies and hold on. Because remember, price fluctuation has nothing to do with what the company is doing. It can be so much price fluctuation no matter what's happening with the company. The company can be doing tremendously fine and it's still moving up and down. So remember, focus on the earning power of the company is returning high on invested capital, high returns on investment capital, high return on equity, book values going up, revenue growth. If those things are going up, they're stable. Let go of all the price fluctuations because we know that is not our doing. That's just the market acting in the short term, right? And then the last thing I want to go through in this book, which is really good advice to end this whole book review, is two reasons so few of us profit from 100 to 1 in stocks are the first, that we do not try to do so, and second, that even when we are wise or lucky enough to buy one, we do not hold on. To buy right requires vision, courage, faith that is evidence of things not seen, things not susceptible of mathematical proof. To realize 100 for 1 requires patience, extraordinary tenacity, and the will to hold on. So that's an amazing ending to this book review. Guys, you have all those things. And remember, out of those things, patience is one of the most important qualities you can have as an investor. So guys, if you like this book review, if you like this video, like it, subscribe to my channel. I'll get back to you in the next video. Peace.